These macroeconomic charts will blow your mind. Let's dive right in. First up, a picture is being painted of a global depression, deflation. Check out this chart. This comes from Tavi Costa. You can see the US percent of yield curve inversions. Right now, bond yields are inverted when you're comparing the 10-year to the 30-year to the 7-year to the 5-year. You don't want the yields on these bonds to be skewed and out of whack. And that's what's happening right now. The yield on the 3-year is way skewed compared to the 10-year and the 30-year. And so right now, the US percent of yield curve inversions, look at that spike. Look at what happens every single time it breaks that 70% threshold. Let's go back in history. We have the COVID recession. That was a massive financial collapse saved by the Federal Reserve, which is why the market pumped right after that. The housing bust, 2008, everyone remembers that. The tech bust, misery for technology assets back then. Savings and loan crisis in 1990, double dip recession in the 1970s, stagflation, and then the inflationary bust in 1973 and 1974. This is just painting a picture of crisis. Now, again, we're in a centrally planned economy, which means that the Federal Reserve has its finger on the market. It decides when markets go up, when markets go down, because as of right now, they control the oxygen of the financial system. They decide how well everyone can breathe. Do they lower interest rates just a tad, pump markets like they did in the COVID crisis, or do they raise interest rates like they are doing right now to fight inflation and crashing everything? Let's keep looking at charts. World stocks have had the fewest positive trading days in over a decade. This comes from Charles Schwab. And so you can see markets crashing because the Federal Reserve right now is choosing war. They are choosing to raise interest rates and crash assets. And that's what's happening. So you have the yield curve inverting, you have stocks coming down, and then right on the screws, you have inflation coming down. This is German PPI month over month, going from the highest ever to the lowest ever in a few months. This is just one country. Just based on this chart, we're seeing massive deceleration in inflation. And then let's just take a look at consumer goods inflation, right? This is the real sticky one that the Federal Reserve has been trying to bring down, right? The cost of food. And so this chart is fascinating. It comes from Andreas Steno Larsen. You can see the Shanghai Containerized Freight Index. So how expensive is freight from China in blue? Well, it's collapsing right now. And normally goods inflation follows. So we may just see a decline in goods inflation. Now, again, if inflation comes down, that emboldens the Fed to let a little more oxygen back into the financial system, and that causes assets to pump. Now, it's a fine balance that they have to play because they don't want to lower interest rates too fast and cause inflation to spike out of control again. So maybe they'll keep the pressure on a little longer. But this is emboldening the Federal Reserve. This comes from Andreas Steno Larsen as well. Housing supply through the roof, meaning there's a lot of houses being dumped in the market because people just can't afford them with these high interest rates. Try looking at how much a mortgage will cost right now on your house or your rent. It's all too expensive. And so months supply overall, you can just see it inverted, spiking. And because of that, you see real estate prices about to collapse as well. And so we're painting a grim picture in terms of assets, but not so grim of a picture in terms of the Fed potentially slowing interest rates down and pivoting. A record 24% of homes had a price drop in October. So oxygen is being taken out of the financial system as we speak, and you can just see it in real time. Look at corporate insider selling pressure. This comes from Sentiment Trader. We've seen massive selling from corporate insiders at historic levels. Generally, we are at a bottom when this happens because at this point, it seems like the selling pressure is exhausted, just something to stay on top of. And then you have this S&P 500 Metals and Mining Index. This comes from Crescat Capital or Tavi Costa. Look at how low it is. We're comparing price to earnings, meaning the price of these assets is ridiculously cheap historically compared to earnings. Back where it was in the depth of the financial crisis. We all know what a great buying opportunity that was. And so if you have prices at the same level as the last great global deep recession that we had, it's generally a good time to potentially consider taking a look at some of these assets. And so we'll stay on top of this market. Thank you for watching. This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.